Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. We have a massive episode today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are right in the middle of one of finance's great mysteries.
What's that?
We've just come off earnings season in America.
Yep.
And now we're in reporting season in Australia. Two words for exactly the same thing.
Yes.
Which one is the right word?
Reporting?
I don't know. It annoys me so much.
Yeah.
I literally, I write our daily news email. Everyone should sign on if they're not already. It's a good way to keep up to date. I literally find myself switching words based on geography.
Okay.
Which makes no sense.
No.
So anyway, but we are in reporting season here in Australia. We've got the first week of company news.
Yeah.
And we're going to cover that later on in this episode because there's some really interesting stories emerging. And it's been a pretty good first week.
It has been. Yeah. Well, yeah. Let's see how it plays out.
Yeah.
We're going to cover that at the end of the show. We've got a community question about comparing two ETFs that make up the one ETF portfolio. But Ren, let's just start with general news and views.
News and markets.
Last Thursday, we spoke about sports betting and the
Yes.
impact that the government's proposed ban on gambling ads is going to have on betting companies and also, I guess, TV rights
Yes.
and the media companies. But you wanted to just close out with a couple more astounding stats that are coming through.
Yeah, well, I think in the conversations since we recorded, there's been a lot more focus on it. There was a really good article from Annabelle Crabb in the ABC that we'll link in the show notes. And it had a stat that I think really frames and contextualizes this. 17% of all regular gamblers are problem gamblers. That's the problem with all this advertising. It's like a massive percentage of people that gamble regularly have a problem with it, and those people are the ones that are seeing these ads constantly. So I think that's an important stat to contextualize it. But another stat that came out from Seven West's report was the overall TV ad market is down 8%. Like revenue for TV ads, for broadcast TV, is down 8% year on year. TV's dying.
Yeah.
Yeah.
Big
I
time.
think like that's the headline. Slowly but surely it is dying. And it kind of annoys me, some of the conversations that have happened. So like Bill Shorten came out and said, we can't ban gambling ads because gambling ads are keeping linear TV afloat.
Yeah.
And it's just like the most short-sighted thing I think we've seen for a while, because in the same, like we're working in a media company, we're selling media ads, and we're seeing that linear forms of media, TV, radio, are losing market share to digital forms.
Yeah.
And gambling ads, like every other form of ads, are leaving the median.
Yeah.
Slowly, sure, because like whilst they're sport on, they're still going to advertise there. But like Bill Shorten's argument isn't a long-term structural solution to save linear TV, because in 10, 20 years, as audiences leave linear TV, gambling ads will leave it as
gambling
well.
ads on podcasts.
So I don't know. It's just like so short-sighted. It's like, how can we save it? How can we keep it afloat for the next 5 years?
Yeah. Now, Ren, we should say there are many different ways to get help if you need help. There is the National Gambling Helpline. You can call 1-800-858-858. Check that out. So, speaking of TV, cable TV. Just firstly on ads, I don't know if if you pay for Prime, Amazon Prime.
Yeah.
But it is really pissing me off now that
they've
you
put
pay
ads.
and there's ads in there. What is going on?
I know.
What is
it's
going
so
on?
annoying.
It's so annoying.
Is there a more
what am I paying for?
Is there a more premium tier where you can avoid the ads?
Not that I'm aware of, but I'll have to have a look. Maybe they've done a Netflix, but they haven't. I haven't been given the option to reduce my payment.
No.
Like
no.
Netflix,
Yeah,
you could reduce.
Yeah.
So anyway,
Yeah.
stitch up. But cable TV, Ren, News Corp have reported that.
Well, hold on, just on that point.
Okay.
That kind of reinforces the whole Bill Shorten thing.
Exactly.
Because while
That's
Netflix
what made
and
me think of it.
Amazon,
Yeah. They'll just take it all.
That's where the gambling ads are going to go.
Especially as they start playing in sports rights.
Yeah, true.
Next, you'll just have Netflix and Amazon Prime showing NBA and Premier League, and be full.
You can't solve one problem by perpetuating another Bill Shorten.
Done.
On that, and I know we need to move away from sports betting, but it's obviously got us riled up. I think the classic example of a way that you could try and help solve the problem is when they banned tobacco advertising. And specifically in Victoria in the 80s, so there was a national ban in the 70s, but then in Victoria they passed more laws about tobacco advertising in the 80s. And Victoria had this system where Vic Health would backfill the advertising spots taken up by tobacco. And tobacco was just as prevalent as gambling. In the late 60s, early 70s, there was a tobacco ad every 8 to 14 minutes on TV. Adjusted for today's dollars, so adjusted for inflation, they were spending just shy of $200 million a year. So like equivalent to gambling. And Vic Health said for X number of years, while you sort of transition out of the reliance on tobacco, or like you find other ways to fill that revenue gap, we will backfill it with public health messaging. And they bought that advertising spot from the broadcasters and did anti-smoking messaging. I think seatbelts was a big one. And there was like one or two other key health messages that they backfilled for like X number of years and probably like phased it out. There are solutions to some of these challenges that don't require us to just keep the status quo.
Yeah.
All right, now let's go back
to this. All right. Cable TV. News Corp reported, as I said, full year results, and it shared plans to sell its stake in Foxtel. So Foxtel is a joint venture between Telstra and News Corp. Yep. At its peak in 2015, Foxtel had 2.9 million set-top box subscribers, but to today it is less than half of that, 1.2.
Yeah, so Foxtel's overall subscribers are up because of Binge, KO, Flash. You remember Flash?
Forgot about that, yeah.
But
And just to be clear on that, Foxtel essentially provide the content, or they are those. Binge and KO is just a spin-off of that content.
Yes. Yeah. But the set-top box was like $90 a month. So I don't know who's still paying. The 1.2 million people still paying it, but like that was the profitable part, the more profitable part of the business. Apparently, Nine were looking to buy it, and they've looked to buy it a couple of times, but they haven't been able to get the deal done. They reckon it will go to like an overseas private equity player or media investor or something.
I can't see what you do with it from here though. Like, you're going to struggle to convince people to go back to that unless streaming, as it is already, becomes so expensive individually that you're forced back to a model like that.
Yeah. I don't think this would happen because they don't have the money. But if I was one of the big US streamers that were looking to come to Australia, so HBO Max is looking to come to Australia.
Oh, yeah.
And then NBC Universal's Peacock, I think, is also looking to come to Australia.
Just customer base.
No one wants N+1 streaming service. No one wants more fragmentation in this market. But if they had the balance sheet to say, look, we'll pick up Binge and rebrand it and make it Max, like you could see that being
true. Yeah, not bad.
But I don't think that's going to happen.
No,
I think it would just be some private equity player that buys Foxtel, and it's a dying business. It's not just a dying business in Australia. We should be clear.
No,
in the US, it's dying an even more spectacular death.
Yeah, well, Warner Brothers wrote down the value of their cable business by $9.1 billion.
Yeah.
Jeez. It lost its sports broadcast right, and fees from cable and satellite distribution are also down. As a result, their shares were down 11% to an all-time low. So not great.
Yeah, it's funny. Warner Brothers Discovery owns TNT Sport, which had part of the NBA broadcast rights, and they lost. The next 10-year deal has been signed, and TNT lost out. And the streamers took their slack, basically, like Amazon and stuff like that, are getting those games. And they're suing. And it just then reminded me of Elon suing his advertisers as well on Twitter because they're not advertising with him. It's just like, you don't get the deal.
Sue. What an idiot. Anyway, a couple of other news headlines that have caught our attention. Dating apps, Ren, are getting whacked.
Yeah.
We haven't been on a dating app in a while, but Bumble's share price are down.
You've never been on a dating app.
I've never been on a dating app, no. Bumble's share price is down 33% after reporting quarterly earnings and forecasting growth of only 1 to 2% for the year.
Yeah, previously they'd been guiding 8 to 11%, so a big drop off. So Bumble's shares over the past 12 months are down 64%.
Scheißen.
Yeah. And then Match Group, which owns Tinder and Hinge, is down 22% in the past 12 months.
Wow, less people dating.
I think
Less people using.
I think people, particularly like Gen Z, are off the dating apps.
Really?
Well, to the extent that like millennials, I think, were peak dating app.
Okay, yeah. Well, so they're back on OG.
I think, yeah, well, I mean, that's just what all the usage sort of numbers
Good on
sort
him.
of say.
Good on him.
I don't know if it's OG or it's like
something else.
I don't know.
Yeah, metaverse. Yeah. And finally, here's a big one that came out at the end of last week. ASIC are suing the ASX for misleading comments.
Yes. They are alleging that the ASX misled the market that they run.
Yes.
Yeah. Because the ASX is the stock market operator, but it is also a company listed on the stock market, and they have obligations to truthfully update investors with all sort of known information at the time, like any other listed company. ASIC are alleging that they didn't when it came to their chess replacement project.
Yes.
In the peak of Bitcoin mania, the ASX announced that they were going to replace their chess system with a blockchain-based system. Yeah. And that's where the trouble started.
Yeah, to the tune of a couple of $100 million. And
the CEO's job.
Potentially
now the chair's job.
Yes, not looking good. But one that we will keep an eye on. Now, if you want to keep up with the headlines, make sure you subscribe to our daily newsletter. We'll not only give you the business headlines, but some of the other major ones that are playing out around the world. And there are questions from the community answered by the expert as well. So sign up to that. We'll put a link in the show notes. All right, Ren, it's time for
MONEY. Let's ask the community.
Hey, Equity Mate.
I just had a question.
We have a question that has come in from Daisy today. Daisy says she would love for us to compare the pros and cons between ETFs like VDHG and DHHF and VGS and BGBL. These are otherwise known as the One-ETF portfolios.
Okay, so
Some jargon there.
You've just used 4 acronyms, so just tell us in...
So the first 2 is Vanguard Diversified High Growth, and the second is Betashares Diversified All Growth. Mm-hmm. And then the other comparison was Vanguard's MSCI International Shares and then Betashares Global Shares ETF. So 2 comparisons, 2 massive ETFs, and wanted to know, in her view, they're the one ETF portfolio, and wants us to just give our thoughts on the 2.
Conceptually, let's start with what the one ETF portfolio is.
Yeah. So we've spoken about this and we've written about it in our book, Don't Stress, Just Invest. But there are ETFs these days that are constructed that give you access to all cap, all world. So what I mean by all cap is mega caps, large caps, mid caps, small caps, plus some income investments at a global scale, developing markets and also developed markets. So these ETFs are designed that you can make one investment and get true global diversification. In some instances, you get up to 16,000 stocks in one ETF. So why they're called the one ETF portfolios for that reason. You can set these up in your portfolio if you're not majorly interested in investing and just have these as your investment portfolio for the next 40 years.
Yeah.
Yeah.
Now, there are 4 ETFs that Daisy has mentioned there, and I think she's actually separated them well. So VDHG, Vanguard Diversified High Growth, and Betashares All Growth, and then the Vanguard International Index and BGBL, which is Betashares Global Shares ETF. They're slightly different in how they're structured.
Yeah.
They all own very similar assets at the end of the day, but VGS and BGBL are just... they are an index ETF in and of themselves. So they take about, over 1,000 stocks, 1,500 stocks, rank them from biggest to smallest, and then weight them accordingly in the portfolio.
Yeah.
And as companies get bigger and smaller, every quarter they will rebalance them. They're like a global index fund.
Yeah.
Then,
interestingly, they're both ex-Australia.
Okay, well
Yeah.
that is interesting. Yeah, I guess that because they're designed for people that want to complement a Australian share portfolio.
Yeah.
VDHG and DHHF aren't indexed in the same way. They're like ETFs of ETFs.
Yeah.
And confusingly, the ETFs that are in the ETF are indexes.
Yeah.
So like for the Vanguard one, it's like vast Vanguard Australian shares and like an American shares one or an international shares one.
Yeah.
But the weightings of each country are set by the ETF issuer.
Yes.
So, you know, like VDHG has what, like 30% Australian shares?
VDHG, about 36. Yeah, you're right. Yeah.
But it's not like Australia is 36% of the global stock market index.
No.
So two of them are just give us everything, put it in order, rank them, weight them accordingly. And then the other two are, we're going to give you different exposures, sort of preset exposures almost.
Yes.
Yeah.
So really that it comes down to, you need to look under the hood. There are slight nuances between VDHG and DHHF. VDHG is much broader, 16,000 total stocks, whereas the Betashares diversified is only 8,000.
Only is a relative term there. Yeah.
So it's also important to recognise that DHHF is 100% allocation to equities, whereas Vanguard's high growth has a 10% weighting to income. And then the major differences are the management fee that you'll pay. So 0.27% for Vanguards and 0.19% for Betashares. So if you really want our opinion, my opinion is DHHF. Only because...
Of all four?
No, just comparing to your point, if you're looking at all-encompassing world, I would be going DHHF between that and Vanguard's VDHG, just because I like the 100% allocation to stocks
and the lower fee.
Yeah.
Yeah, that's fair. I think that logic makes sense.
And that has driven slight outperformance over the past 3 years, 8.55% for Betashares, 6.73% for Vanguard.
As you would expect.
So
like
but then to your point, Ren, if you look at the other two, the international shares for Vanguard and the Betashares Global, they are almost identical except for the management fee. And so if you look at Vanguard, 0.18%, whereas Betashares come in at 0.08. So for me, I'm going global shares, Betashares Global.
Yeah. There is no bad option here. I think we want to be really clear. And if you got confused by the amount of times we said ETF then or the amount of acronyms we used, like any four of those options, if you dollar cost average into and you build wealth over time, you're good. Like you should achieve your financial goals as long as they're not crazy.
Yeah.
But if I was to say, all right, I'm just going to do one of these for the rest of my life, I know I'm courting controversy, but DHHF is probably the one I would just say.
Yeah.
Yeah.
Me
Because
too.
the fees are lower. It's 100% allocations to stock rather than that fixed income component. And I think I prefer the sort of, I guess, like pre-set allocations rather than just like market cap weight everything.
Yep.
Because right now the challenge is if you market cap weight everything, you get like 70% US.
Yeah.
Whereas the ones where they preset it a little bit, you could argue there's too much Australia in there. They both have sort of like 36% Australia, but it's a bit more like you're going to get growth from wherever it comes in the world rather than like hoping that the US keeps doing this thing.
Yeah. Well, thanks for the question, Daisy. If you have a question that you'd like to like us to answer on the show, head to equitymates.com/contact and all the information is there. We're going to take a quick break, and on the other side, we're going to do a wrap of the first week of reporting season here in Australia. We'll be right back. Welcome back to Equity Mates. Now, Ren, before we jump into reporting season, bit of a public service announcement. We know we do a lot of content here at Equity Mates, sometimes 5 episodes a week.
No.
4? Sometimes 4 on Equity Mates.
On Equity
4
Mates.
max on Equity Mates. Up to 2 a week on Get Started Investing, and it can be difficult to keep up. We recognize that. If you enjoy the Monday show, the show we're doing today, 3 segments, news and views, bit about our portfolios. The good news is that also repeats on Thursdays.
It repeats. It's not a repeat.
No, it's not
episode.
a repeat. We do the same format on Thursdays. And Ren, the only reason I'm bringing this up is because Having spoken to some Equity Mates listeners in real life over the past couple of weeks, because of the amount of content, some are just listening to the Monday, thinking that that's where it's you and I chatting.
Okay.
And so good news is you get us chatting 2 times a week,
Yes,
Mondays and Thursdays.
Mondays and Thursdays. Mondays and Thursdays.
Mondays and Thursdays.
All right.
Now, reporting season.
Yeah, let's get into it. It's earnings season or reporting season, depending on what side of the globe you are listening to this. But we've come out of America, mixed bag over there, I would say. And so everyone was interested to see how Australian companies were doing, what we could learn about the Australian economy, what we could learn about the Australian consumer, and I guess it's going to give us our best indication of, all of those questions around where to for inflation, like is it still in the supply chain or is it in now labour and services, where to for, the economy in a recession and how's Australia's property market and Australians going with mortgages? Like, there's a lot of questions that we're wondering, and this is the time that we start to get some answers.
Yes.
So, where do we want to start?
Well, let's start with one of Australia's largest companies, CBA.
Yes.
Shall we?
Yeah.
Get that out of the road.
That helps answer some of these questions.
Yes. Yeah. So CBA reported a $9.8 billion profit for the full year, which was down 6% from last year. Now, I guess the news coming out of it was around their mortgage arrears, which was up from 0.92% to 1.3%. Doesn't sound like a lot.
Yeah.
But when you contextualize that with the value of their mortgage book, it's a fair chunk of change.
And the amount, that's a lot of Australians now falling behind on their mortgages.
Yeah.
I think it's important to stress that that's kind of 1.3% isn't majorly over the historical average.
It's not worrying in a sense.
Yeah. Except for all those people that are now struggling with their mortgages.
Yeah. You know what I mean.
Yeah. It's not a sign of things being massively out of whack.
Yeah. I heard Marcus Padley talk about CBA yesterday, and he said that profit is $9.8 billion. It's $367 of profit for every single person in Australia. Wow. That's how he, I guess, tried to help everyone understand the enormity of it.
Yeah.
And believes that it's one of Australia's best income stocks going around. You can't beat it.
Yeah. Okay.
Yeah.
Interesting.
Yeah.
Well, look, no one gets excited about CBA, so
No.
let's move on. I think this week in reporting season has reminded me of 2 golden rules when it comes to reporting season. So the first rule is it's all about expectations in reporting season. And we saw the good and the bad of this this week. So I don't know if this is the good or the bad, but JB Hi-Fi was one big example of that.
Yeah.
So JB Hi-Fi saw its shares jump 8% after announcing.
Yeah.
What do you think happened?
They beat expectation, but they reported lower profit and sales.
Yep.
Yeah.
Sales were lower and profit was lower, but
Yeah.
shares jumped 8%. I think they're up now more than that, double digits.
Yeah.
And that was because expectations were even lower than that. So their business didn't do as well as last year, but their shares went up.
Yeah.
So that's one example of expectations. Here's another example. CSL, the healthcare company, they reported and shares fell 4%. Oof.
Ow.
Something didn't go well,
No.
maybe? No, how's this? 25% profit growth.
Whoa.
And they forecast double-digit percentage profit growth for each of the next 5 years.
Wow.
Yeah.
That's impressive. So that's what they delivered and forecast. Yet stock fell
4%.
4%
Yeah.
because markets wanted more.
Yeah.
God.
So
Stuff being a public market, a public company, honestly.
Well, it's just like when you see, you watch Alan Kohler on ABC News at night, and he will talk about how shares went up and down.
Yeah.
But that isn't an indication of how the business went. That's an indication of what the expectations were already built into the price. So that's what you got to remember. Number one golden rule when it comes to reporting season: expectation. Speaking of a company beating expectations, let's talk about Temple & Webster because the
AI company.
Yeah. So for context, Temple & Webster is an online furniture retailer. When ChatGPT first was making waves, they tried to ride that wave and call themselves an AI company because as far as we can tell, they rewrote all their descriptions of
Yes.
furniture with ChatGPT.
Yes, that was it.
Yeah.
Tried to use it for better marketing copy.
But here's the thing, Bryce.
Maybe it's
that
worked.
marketing
Has it
copy
worked?
may have worked. So profit was more than 20% above what analysts were expecting. And so the share price was up 23% in a day.
Wow.
Yeah.
Wow. Is that going to sustain it? Who knows? But that's another indication of what it means to beat expectations. I had a look at it though. It's a very expensive stock.
So for Temple & Webster, we should actually speak about the results because they were interesting. So revenue was up 26%. Love to see that.
Yeah.
Profit was down 79%. Now, keep in mind, that was still 20% above what analysts were expecting. Now, this is a story of expectations management. So like as a public CEO, one of your key jobs is to engage with your shareholders and investors and make sure they know what's coming. No surprises. That's good public market management. And so even though their profit fell almost 80%, like they had made the market aware that the market knew they were investing for growth. So their profit was going to be down. And then they beat the expectations that they had lowered in the minds of their investors.
Yeah. But don't think that means you can go out to the market and just say something ridiculous knowing that you're going to beat it.
Yeah.
You have to,
if you
update them accurately.
If you start saying things ridiculous, then you go back to where we started this episode,
ASIC
getting
will be
sued by ASIC. So that's, I said there were 2 golden rules. The first golden rule is expectations. And I think as long-term investors, what we should be doing is looking beyond the share price movement and how the companies are going.
Yep.
So that's 1. Rule number 2, companies that have good news like to go early. Companies that have bad news like to go late.
So what you're saying is we've seen all the good ones.
Not all the good ones, but like it's been a really good week.
It has been. Yeah.
Like you can list the companies that I think had good news to report. Some that we haven't mentioned here that we should. Pro Medicus.
Yep.
Just shot the lights out.
AGL.
AGL, yeah. Who would have thought?
Profit of, I think, what was it, 720 thereabouts after a loss of 1.2 billion or something last year.
Okay. Cochlear raised their dividend like 24% or something.
Yeah.
Telstra even raised their dividend.
Yeah.
Like a lot of these companies had good news or like there were aspects of the report that were good for investors, which led to, I guess, a little bit of a buoyant mood. Even Seven Group, like not Seven West, let's talk about them in a sec, but Seven Group, which owns, Boral and a bunch of different companies, not just the TV network, they had a good report.
So there's either 2 things that play out from here. The trend continues, or as the weeks go by, generally we've got about 2 weeks to go or thereabouts, we're going to start seeing some of the companies that want to bury it at the back end. Yeah.
Like we haven't seen a lot of consumer-facing retail.
Yeah.
A lot of non-discretionary retail, except for JB Hi-Fi.
Yeah.
But
It'll come.
But I think let's close it out by talking about one company that did disappoint, Seven West Media.
Yep.
So that is the owner of Channel 7. We said earlier in the episode, they reported that the total market for TV advertising was down 8% year on year. Seven West's profit down 69% year on year.
Oofed.
Yeah.
Wow.
I don't know who would want to be in linear TV.
Yeah, well.
Except for sports bet.
Yeah, well, yeah, it's fascinating. That hurts. They're in trouble. And I think it was a number of episodes ago, we were just speaking about more broadly what's going on with Channel 10, 9 and 7. And who knows what the future holds for these channels in 5 or 6 years. Like
my gut, and this is a sort of, like there are people that know more about this world than I do, but my gut is that pure play media is going to really struggle because if you look at the media that's succeeding, it's subsidized. It's like cross-subsidized by something. So like, Amazon can afford Amazon Prime. Apple is pushing more into media. Netflix is pure play, but slightly different model, obviously, different cost structures. And actually their users pay, whereas like a lot of linear TV, their users don't pay. But if you look at like perhaps the Stokes family, Kerry and his son Ryan, will be willing to wear losses on Seven West for longer because there's like a prestige that comes from
a
owning
big media
TV.
asset. Yeah.
And so maybe, like if you were investing in Seven, you'd be looking at Seven Group, not Seven West.
Yes.
But then you look at Nine, and it's like it's got its newspaper division, it's got its radio stations, it's got its TV. It needs like something. It needs a cash cow.
Yeah.
It needs its Boral, or it's just something that can just print reliable income.
The Packers back.
Oh yeah, it would be so challenging.
Yeah.
Like I don't envy their jobs at all. Like,
No.
You just look at a cost structure that was optimized for 20 years ago.
Yeah. Well, watch this space. But that's probably a good place to wrap it. We'll be back on Thursday with more reporting season updates, as well as I said at the top, make sure you subscribe to the Equity Mates newsletter, because we will be keeping you updated on a daily basis with what's happening in markets and news headlines around the world. Link is in the show notes. But that brings us to the end of today's show. A massive thank you for listening, as always. If you've enjoyed it, please leave a rating and a review. We really appreciate it. And Ren, we'll be back next episode.
Sounds good.
Equity Mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.